examples on the screen of how a claim would be calculated. Very simplistic for the purpose of the training, but it gives you an idea of how we would calculate it. And then we'll get on to some of the other the clauses, and finally we'll finish with maybe how we could assist you going forward on helping with your business interruption. So any questions before we start? No? All good? Excellent. Well, I guess one point for me, look, this training is for you. This session is just for you. So if you have any questions, if something doesn't quite make sense, please shout out. Okay, I'm happy to take questions and pause and go through those issues as we go. I'm sure that there are others in the room with similar questions. So it's for your benefit. So please shout out if you want to. Okay. So let's start with looking at a little bit of an introduction to business interruption. I should highlight that I'm starting at the base, the bottom level, okay? There will be some in the room who are very experienced in business interruption, and therefore this is going back to basics for you, but there will be others who may be not as familiar with it. So apologies for those with expertise, but just bear with us. I'll bring you all along on this training session. So to start with, business interruption sits within the property policy. Okay, so that property policy, sometimes it's called an industrial all risks or IAR, industrial special risks, ISR, or sometimes it's known just simply as PDBI policy, relating to property damage and business interruption. So that's the term, and property and business interruption sit hand in hand. Generally, a policy has two sections. Not always. I know your policies will have other sections added to it, but for the purpose of the training today, we're just thinking two basic sections. Section 1 protects the assets of the business. This is what we call the property damage section of the policy. Section 2 protects the income of the business. So this is what we're going to call business interruption. Okay, think about it from a financial perspective. The balance sheet is protected by Section 1, property damage, and the profit and loss account, your income statement, is protected by Section 2, the business interruption section. Okay. The first thing that I would like to highlight is the what we call the indemnity provision. Okay, this will be in every policy. This is a standard wording that I've got here, not specifically taken from your wording, but you'll find that it's the same wording in pretty much every policy that's out there. Without going through all the details on the left, that can all be broken down into a very simple three-step process. Okay, there must be an insured peril that causes insured damage that results in business interruption. Or to be more precise, I mentioned earlier, this is called an all risks policy. What this means is that everything is covered unless it is excluded. So being more precise in these definitions, there's a peril that is not excluded that causes damage to property that is not excluded that results in business interruption. If you get that three-step process right and you have 3 ticks on an event, then you can have a successful business interruption claim. If any one of them is missing, you can have no claim. So for example, you've had a recent earthquake up in Thailand. If you had an exclusion for earthquakes, then it doesn't matter what damage has occurred and what interruption you might have suffered. If the proximate cause or the peril is the earthquake and that's excluded, you have no claim. Likewise, in terms of property insured, let's say that that the road was damaged in your particular premises from an event, and that road is excluded. And there's a common exclusion for roads, railways, and bridges. Now, if you have that exclusion and it is the road that's damaged that gives rise to business interruption, then there's no claim. Because again, the damaged property is excluded. Okay, so for any claim, you have to have this three-step process in this order. A peril that's not excluded, causing damage to property that's not excluded, resulting in business interruption. I hope that's clear. It's a very good foundation for you to think about in the future. So if you have any kind of event that crops up, if you follow through this three-step process, you will 99.99% of the time, you will come up with the right answer as to whether your policy will respond or not. It's not always perfect. Sometimes you get outliers that are an exception to this rule. Generally, though, this works perfectly. The other important proviso for claim trigger is this material damage proviso. So insurers will not be liable unless the insured's property is insured against that particular event. Okay, so it's important that the property that's damaged is insured. Okay, now highlighting that it's the insured's premise, it's your property. So you have to have insured it. If it's damage to somebody else's property that causes damage or causes interruption to your business, you could still be covered for that. Okay, so we can't stipulate that your customer or supplier has to have insured their property because that's their business. That supplier or customer might have loads of cash and they don't need to buy insurance. And therefore, there's no requirement for them to have bought it. However, if that customer or supplier has a loss that results in you suffering a business interruption exposure, then the property that is damaged has to be of the type that would have been covered if it was yours. The best way to explain this is imagine that you're a power station and you generate based on coal. Okay, so you need to get coal to generate power and you get that coal from an underground coal mine. Let's assume that there was a loss in that coal mine. It's underground. There was damage to the underground mine workings. Well, there's often an exclusion in a policy for underground mine workings. So you as a power station might be thinking, oh, well, why would I need to bother insuring underground mine workings? I'm a power station. I don't need it. But the problem is if the proximate cause of the loss at the mine, which means they can't provide coal to you, is damage to something that's excluded in your policy, that means you have no BI claim. Okay, so you need to make sure when you're looking through your exclusions for perils and property that you're thinking about not only your property, first party, but you're also thinking third party property, third party risks, customers, suppliers, the locality, whatever that risk might be. Think holistically, anything that might affect your business. Hopefully that's clear. Before we go on to the next section, any questions?
Can I throw something in there, Glenn?
Sure.
Just to so if there's a loss that where there's property damage which is covered to property that's also covered, but the loss is quite a small one and falls below the deductible. My understanding is that normally the BI that comes out of that loss would be covered, even though there's going to be nothing paid under the property damage.
Correct. That's right. So what we do as a test, that when we're looking at the property damage claim, the issue is it covered or not? If it's covered, then the business interruption will follow. Now, whether there's actually anything payable or not depends on that level of deductible. So it might be that the insurer doesn't have to pay anything on property damage because it's too small. But it's still covered. They've still accepted indemnity for it. It's just not big enough. But BI will still follow, and there's absolutely no restriction on that because of the deductible issue. Okay.
Thanks. Yeah, thank you.
Okay, well, let's move on to the next section. And what we'll do is we'll go through the gross profit formula. Now, gross profit is the standard way that we would cover. I guess before jumping into it, I'll just highlight the main 4 types of cover that we will see in Asia. So the first one is gross revenue. So gross revenue would only really be used when you have very, very few variable costs, preferably no variable costs at all. So things like a port, for example, huge infrastructure, huge fixed costs, but hardly any variable costs. A lot of financial institutions, very few variable costs. Even in your business, a lot of offshore stuff will have very few variable costs. So what it means is that gross revenue is often the way that can be used for those entities with few variable costs. If you do have variable costs, though, then you will select gross profit. Gross profit, as we'll see very soon, is just simply revenue less those variable costs that there's no point insuring. That's the second type. The third type is standing charges. We're going to get to that a little bit later. That's essentially just insuring your fixed costs only. So there's a huge portion that may be uninsured, but it is an option that you can go down. And the fourth option is increased costs only. Now, realistically, for your type of business, I would suggest that gross revenue and increased costs of working only are probably not going to be appropriate. That can be explored separately if you'd like. It's unlikely. The 2 main ones that might be of interest for you would be gross profit and standing charges. Hence, they're the ones I've picked to go through in detail today. So we'll start with gross profit. The first point to note is that there's a time factor for business interruption. Okay, there isn't when we're dealing with property damage. Property damage, yes, it has to be repaired, reinstated with due dispatch as quickly as you can. Whether it takes you a month or 10 years, as long as you have followed that due dispatch process, there's no limit on that property damage. But there is on business interruption. And you decide on how long you want as a period of cover. That cover generally starts with the occurrence of the damage and ends a certain number of months later. Okay, there's a maximum in your policy. Could be 18 months, 24 months, or 30 months, whatever you decide to have. But the actual indemnity period will finish as soon as the results of the business are no longer affected in consequence of that damage. That's the period of cover. Now, first point of interest on your policy, I did notice you had a very interesting clause that actually enabled you to delay the start of the indemnity period. That is incredibly unusual, but it can be very useful. So you might find in the first month or 2 after an event that you're not actually suffering business interruption losses yet. You may have a big store, tanks full of finished goods product that you can continue to sell, which means that you're not actually suffering a loss of sales yet. And therefore you can delay the start until a period a little bit later. Then it kicks in and you have the maximum period from then. So it's a very useful clause. Most clients do not have that, so it's a useful one. Now the gross profit formula. Okay, so gross profit itself, it has 4 parts to it. This is by far the biggest element of a gross profit business interruption policy. It covers you for the loss of gross profit due to a reduction in turnover. Also, the loss of gross profit due to an increase in cost of working. We then have savings to consider, and there's also an average clause that is often available that needs to be considered. I'll go through all of these one at a time so you understand how each one works. So starting with the biggest, the loss of gross profit due to a reduction in turnover. Now the process that we need to follow, firstly, we need to work out what that reduction in turnover is. Again, I'll get to that in a minute. We then determine the rate of gross profit, and we simply apply one to the other. The reduction in turnover multiplied by the rate of gross profit. So I'll just explain each one in turn. So determining the reduction in turnover. Again, it sounds pretty simple. but all you have to do is calculate your adjusted standard turnover. That's the turnover that would have been achieved had the damage not been suffered. Now, it's the first time that I'm really talking about the word damage, but it's a very, very important word. Okay, you are not insured for earthquake or flood or fire or explosion. You are insured for the damage that arises from earthquake, fire, flood, or explosion. Okay, subtle difference, but it's a very important difference. It's the damage that triggers anything. So our adjusted standard turnover is what you would have achieved had the damage not been suffered. We will then deduct maintained turnover. That gives us our reduction in turnover. Sounds nice and simple. That calculation of adjusted standard turnover, though, is incredibly difficult. We have to essentially predict what would have occurred had something not happened. Now, it's only the damage that we pretend didn't happen. Everything else does. So whether it's a wide area damage event, that still happens. Anything to do with exchange rates, competitor activity, all those extra events that might have occurred, whether it's to do with your business or the environment as a whole, we've got to assume that they have still happened. It's just the damage didn't happen. And then we predict how your business would have achieved the performance. Now, how do we do that? Well, it can be very challenging, but we'll look at historical actual data. We'll often look years into the past, depending on the type of business. Generally, it's at least 2 years. Sometimes it has to be longer. We'll look at forecasts. We'll look at budgets. We'll look at market data. All sorts of information that will give us a clue as to how you would have actually performed during that period. And there's one other thing that's very important to this, and this is the adjustments clause. This enables us to think about all of those external factors. So it basically says that the figures shall represent the results which, but for the damage, would have been obtained during the relative period. Now, we think of everything, and the adjustments clause can be good or bad. Okay, so there's some occasions when the adjustments clause, so if you, for example, are planning to do an expansion in 6 months' time, but because of this event, you can't do that expansion. And then we can factor that into the expectation of how you would have performed. But it can work against you as well. So if there are external factors that would have impacted the market generally, then we have to factor that in. So let's say, for example, you provide a lot of product to China, and then China would have then adapted something to send it to the US. Now, suddenly, with all these tariffs going on in the world, that market for you might reduce significantly. That might have a big problem for you. We have to factor that in still. So it can be good, and it could also be bad. We have to apply this adjustments clause also to things like rates of gross profit and annual turnover, standard turnover, which are certain parts of the overall calculation for business interruption. So what I'll do now is show a little example in practice about how that process works in terms of calculating this loss of gross profit due to reduction in turnover. Okay, so we assume before the loss that the business is earning $100. That's the full size of the bar on the left. The light blue is the variable costs. So they're the costs that will vary in direct proportion to turnover. You don't need to insure those. Okay, that's your raw materials that you're purchasing to come in. If you're not going to manufacture anything, well, there's no point buying those raw materials. You need to actually only insure those things that are going to continue. Those are the fixed costs. That's the medium blue. So those costs are going to continue regardless of your level of operations, generally. What's left over is your net profit of 20. So that's before the loss. So then we've got two assumptions. Okay, the first assumption is you've lost 40% of your turnover. Okay, it's reduced from 100 to 60. Well, the impact of that also will reduce your variable costs. They've gone from 50 to 30, direct proportion. Fixed costs have stayed the same as you would expect. And then your net profit has completely disappeared. So in loss number one, this is what we call the break-even point. If you make $1 more of sales, you make a profit. $1 less, you make a loss. Worst case scenario is loss number two. You lose all of your sales, 100 to 0. There's no variable costs, you don't need it. You don't need to buy raw materials. And you now have a net loss of 30, which is essentially those fixed costs that you're continuing to incur. What does it look like from a numbers perspective? 100 less 60 gives you the $40 of reduction in turnover. Loss number two is 100 less nothing, gives you 100. Nice and simple, straightforward. We then have to apply the rate of gross profit to it. Okay, so from a PTT perspective, I looked at one of your policies and it defines uninsured working expenses as the cost of raw materials. That's all it is. Okay, so the uninsured working expenses are the variable costs that you choose not to insure. Now, in your business, I would expect raw materials to be easily the largest variable cost, but there may be others. So some of the other kind of costs that might be included would be, chemicals and things like that. Are they considered raw materials or not? Variable maintenance, repairs and maintenance. If they're variable, they'll vary in direct proportion to revenue. Well, what happens about those? If you're not operating, you're probably not incurring them. At the moment, though, they're still insured. You can have freight, any kind of freight and cartage, things like that. Sales commissions. All of those things are generally considered variable. Now, you might have left them out because they're immaterial in the whole scheme of things. Or it might have been done because it's easier. Pick up raw materials, it's the big one. What about the others? It would be expressed as a percentage overall. And we just simply divide that, the gross profit into the sales overall to get that rate of gross profit. And as mentioned earlier, it's subject to the adjustments clause. So in terms of numbers, this is what it looks like. So the example we had earlier, we had sales of 100, we had variable costs of 50. That gives us gross profit of 50. That gross profit is obviously 50%. Nice and simple. And then what we do, we just simply, in terms of the claim, we just simply have to apply one to the other, and that will give us our loss of gross profit. So here you go. The $40 for loss number one we calculated earlier, times 50%, gives us a claim of $20 loss of gross profit. Loss number two, 100 times 50% gives us $50. Now, if we just think back to the original chart, which looked like this, are we appropriately indemnified by that calculation? Okay, loss number one, we're going to give them $20. Is that right? Well, yes, because here, the $20, that's what we're missing, the profit of $20. So we give them $20, they're back to the same financial position that they would have been in had the damage not been suffered. Loss number two, they're getting $50. Okay, again, that will put them back in the same financial position. That's the $30 of fixed cost they're continuing to incur, plus the $20 they've lost out on. Okay, so it's in equilibrium. It matches. That's the great thing about the gross profit methodology. It puts you in an equilibrium position. It puts you in the same financial position you would have been had the loss not occurred. Whether you're making a gross loss or a gross profit, doesn't matter. At the end of the day, gross profit methodology always puts you back in the same financial position. So we always recommend taking out that method of cover. Any questions to do with the gross profit formula here? No? All good? Okay. couple of other things we need to think about. So savings. Many of our clients get very emotional about savings. These are fixed cost savings. And the suggestion is, well, we are insuring our savings, so why are you taking them out of the claim? Well, we only take them out of the claim when they have not actually been incurred. Okay, so if as we saw earlier, you only have to be reimbursed for the costs that you're actually incurring, the fixed costs you're incurring, plus the net profit you've missed out on. So if you're not incurring those fixed costs, you don't need to be paid them. Okay, so that's why we have to do this adjustment. Now, typically the kinds of things that would come out would be rent abatement, payroll. There's some payroll costs, whether it's casual wages or even permanent wages. Sometimes there is a reduction generally in the workforce after a big loss. Those, if they are as a result of the damage suffered, we need to include those. Light, heat, power, things like that. So there will be some kind of savings that we have to consider. Importantly, though, that if you are dealing with an insurer after a major loss, what you will tend to find is that they will tend to assume that any reduction in fixed costs needs to be deducted. But that's wrong. Okay, so this is where the job of a claims preparer comes in. We will fight very strongly that you have to analyze every single fixed cost to determine if it's come down, has it come down because of the damage, or would it have come down anyway? So you might have taken on more technological solutions, and therefore you've had to, or you've been able to reduce some of your workforce. Well, if you did that, we'd expect to see your salaries and wages drop. Well, that's got nothing to do with the damage. You were going to do it anyway. And therefore, that would be a fight that we'd have with the insurance company to make sure you get paid for that. The other thing to highlight, overheads or payroll that's paid as part of the property damage or material damage section. So if it's paid under property damage, you can't also be paid under BI. You can't get paid twice for the same thing. So the assumption is that if it's been paid under one, you don't get it in the other. Okay? Hope that makes sense. The fourth element of gross profit is the average clause. Now, you don't have this clause in your policy, which is great. But I'll still explain what it means so you know at least what it represents. So the purpose of an average clause is to protect the insurer from if you don't actually declare enough when you're actually taking out business interruption insurance. So it's protection for them. Essentially what it says is that if you declare 80 million, but then you have a big loss, and when we're looking at the loss, we find that you actually should have declared 100 million. You're only 80% adequately insured. So what will happen is you only get 80% of your claim paid. So it's pretty important to get it right. Now, for you, you don't have average. So technically there isn't this protection. We'll get to the volatility clause later, but that's the protection that insurers have got for you. So rather than using average, they've essentially used the volatility clause to make sure that you don't underestimate it by too much. Okay, and we'll get to that a little bit later. So just as a summary overall for the gross profit element of it, loss of gross profit due to a reduction in turnover, plus loss of gross profit due to an increased cost of working. Increased cost of working is essentially just when you're going to spend some money to mitigate the loss. So you spend $1 to save losing gross profit elsewhere. So it could be using temporary plant, you're working overtime, things like that. We then deduct savings. We then deduct average if it's applicable. So that's the basic item 1 loss of gross profit formula. Now we'll cover off one other thing that's an integral part of the gross profit calculation as well. They often call it item 2 in policies, which is claims preparation cost cover. I mentioned at the start that we spend quite a lot of time actually preparing claims on behalf of our clients. Well, this is where our fees come in. So you've got good cover. So you can see the wording at the bottom. It's not our standard cover. Our standard cover would be much better than this in the sense that it makes sure that any costs relating to preparing the claim are definitely covered. This has a little bit of wiggle room, so insurers could try and argue out of paying it. So I would recommend getting a better clause, but at least this is something. So in theory, this will pay the claims preparer to prepare that claim for you. It covers claims under both sections 1 and 2, property damage and BI, although obviously BI is where we spend most of our time. And the value that any claim preparer will bring would significantly outweigh the cost. And you might think, well, why do we need that? We've got a loss adjuster. Surely that's their job. Well, not really. Years and years ago, the job of a loss adjuster was to be impartial, and they would actually assess what the loss is, and the insurance company would just pay it. Doesn't work like that anymore. Okay, so the job of the loss adjuster is to minimize the payout. That's their job. That's the bottom line. Them and the forensic accountants that work for them, they are doing everything they can to minimize the exposure for the insurance company. So therefore, that's where a claims preparer comes in to fight against that. And it's important because otherwise, you are just going to be having a significant adjustments to your claim, which are, they shouldn't be applied. We see it time and time again. We're actually seeing more and more recently as well that loss adjusters are quite aggressive. And then when loss adjusters put a recommendation for payment to insurers, insurers are even more aggressive again, and they will reduce it even after the loss adjuster might have reached agreement with you. So it's an incredibly challenging environment at the moment, and I can't stress how important it is to make sure you have a claims preparer involved, whoever that might be, to make sure that you get help when you have a claim. Okay, that's the end of gross profit. Any questions so far?
มีคำถามไหม
The saving calculation ค่ะ in case that we can identify in advance for the expense that we can foresee, that I understand that some part is a direct cost, so that's why reduce to comply with the sales volume or the turnover. If we can identify it in advance, can we just reflect in the gross profit calculation when we consider on the sum insured and maybe taking out some part that we have to adjust after we calculate?
Yeah, so I'll just repeat the question to make sure I fully understand it. So you're asking if you can identify variable costs in advance, can you deduct them from the revenue when you're calculating your gross profit?
Yes.
At the start? Yes. So, well, the answer is yes. So at the moment, your policy only includes raw materials as a variable cost. But if you can identify other variable costs, then yes, you can also specify those. And that will have two effects, okay? Firstly, from a declared value perspective, obviously the more costs that you declare as being uninsured, the lower the gross profit, and therefore the lower the premium. But the other side of it that you need to be very aware of, when we're then calculating a claim, those costs that you've declared as uninsured, as the name suggests, they are uninsured. So whether they've reduced or not, it doesn't matter. We have to exclude them from the claim. So we have to make sure that the variable costs that we are declaring as uninsured are truly variable. So we need to think of a big event, but we also need to think of partial events. So big events where the whole plant gets destroyed, well, that's easy. Everyone can work out what costs you're going to save. The tricky thing is thinking, okay, it's a partial loss. What's going to happen there? Are we going to save all these costs realistically or not? So care needs to be taken, and you just really need to give it some thought. But simple answer is yes, you can take as many costs out as you want.
Okay. So is my understanding correct? Is that we just have to be careful about the definition, right? So it won't be double count.
It wouldn't be double counted. It's just, do you need to insure it or not? Okay, so there's two. I didn't really cover it earlier. Let me go back to another slide that can be useful to explain something. This will do here. Okay, so there's two ways of looking at gross profit. The first way is the way that we would typically look at it, which is total revenue, say 100, variable costs of 50 gives you gross profit of 50. Sorry, I'm using my thing here. So 100 less 50 gives you gross profit of 50. But another way to look at it is net profit plus fixed costs. It also gives you 50. Now, in theory, both methodologies should give you the same result, whether you come down from the top or you go up from the bottom. But the challenge is what's light blue, variable, versus what's medium blue, fixed. That's the challenge. If you get this wrong, if you understate your variable costs, which maybe you are now, I don't know for sure, but maybe because you're only considering raw materials, what it means is that these variable costs could actually be a bit larger, which brings down your gross profit. Okay, but the opposite, if you go too far and you start taking too many costs out, you could come down here and you end up taking too much out and then you suffer losses. And those losses will not be recovered if you've said it's uninsured.
Yeah.
Does that make sense? Okay.
Thank you.
อยากให้อธิบายเพิ่มเติมไหมคะเผื่อถ้าเกิดให้หนูอธิบายเป็นเวอร์ชันภาษาไทยให้อีกรอบหนึ่งไหมอาจจะเคลียร์เพิ่มขึ้นก็คือว่าโดยปกติแล้วค่ะ Sorry คุณ can let me explain them again
Yes, please do. Yep.
คือโดยปกติแล้วค่ะเวลาเรากำหนดทุนตัว gross profit นะคะเราจะเริ่มจาก turnover นะคะแล้วเอามาลบด้วย variable cost ทีเนี้ยณวันนี้เองอะค่ะตัวกรมธรรม์ของเราอะ identify ไว้ว่าเป็นcost of raw material ถูกไหมคะที่เป็น variable cost ทีเนี้ยเราเป็นเจ้าของ account สิ่งที่เราอยากจะ remind ก็คือก่อนที่เราจะมองตัวไหนเป็น variable อะค่ะให้เราตอบคำถามตัวเองให้ได้ก่อนว่าถ้าเกิดสมมติในกรณีเกิด partial loss ค่าใช้จ่ายตัวนี้มันยัง incur ไหมถ้าเกิดสมมติมันไม่ incur อันนี้ชัดเจนว่ามันเป็น VC มันก็ควรที่จะเอามาถูก take ออกในตัว turnover ตอนกำหนดทุนทำประกันภัยแล้วเราก็ควรที่จะอัปเดตตัว policy อะค่ะประมาณนี้ชัดเจนขึ้นเนาะ
คุณ Gren may ask about depreciation cost. Normally, should we insure this type of expense under BI?
Yes, always. So depreciation should be considered as a fixed cost. It's never uninsured. And the reason is that in theory, those depreciation costs will always continue. Now, there are some occasions when if you have damage to a particular asset and that asset gets completely written off straight away, there may be a fixed cost saving in that. But not always. It depends on the event that's occurred. If you have a loss, say, at a third-party premises that gives rise to business interruption losses, there will be no reduction in depreciation. So you would have a big uninsured loss. The way I tend to look at it is that depreciation is designed to spread a cost that's been incurred, a big capital cost, over a number of years. Now, two reasons for doing that. One is a tax purpose, so it just spreads the risk. But another way to look at it from a financial perspective is that you are essentially, for every single year that goes past, you're reducing your profits by that depreciation, which means that you don't pay out those profits as either you invest them in other things or in dividends and things like that. So you basically retain part of your profit equivalent to that depreciation. What that means is in 10 years' time, let's say, when that asset has finished its useful life and you need to now invest in another one, you've held back enough to be able to then reinvest into a new machine. If you consider depreciation as being variable, then what it'll mean is if you have a large loss, you won't have saved enough to be able to then reinvest in the future. So we always consider that it should be a fixed cost to make sure that if you're not getting that depreciation paid by your customers in terms of everyday sales, you're getting it from the insurance company instead. Make sense? Well, if no other questions right now, I'll continue with standing charges coverage. Okay, so standing charges is another name for fixed costs. It's just a fancy insurance term. So we always recommend gross profit as the best cover to have. It's the cover that's used generally across the world, the global insurance market. And as I mentioned earlier, that gross profit, when done correctly, will put you in the same financial position as if the damage had not been suffered, which ultimately is why people buy business interruption cover. The thing is, standing charges is another methodology. When I showed you the chart earlier, when I showed that gross profit is the equivalent of net profit plus fixed costs, standing charges is just insuring the fixed cost bit. You're not going to insure the net profit. Okay, and you don't even have to insure all of the fixed costs. It's really whatever you'd like to do. But there are problems with that. So what I'm going to do is go through 3 elements of why we see that there are risks in insuring standing charges, and I'll explain how they all work. Okay, so the first thing that I would like to highlight is that you will always suffer uninsured losses if you don't insure that net profit. So if you select standing charges, there will always be an element of your losses that are uninsured in the event of a claim. If you're making a net loss, we have to apply an adjustment. That means that you will always still have a net loss. So a net loss means that your fixed costs exceeds your gross profit. So if you think of the chart that we had earlier, where we had $100 sales, less $50 of variable costs. If you could imagine fixed costs of, say, 60, then that puts us in a net loss situation. Now, if you insure standing charges on a net loss situation, you will be wasting premium because you will never, ever get paid more than the gross profit loss. Again, I'll show you that a little bit later. So let's just work through some examples. So firstly, highlighting this again, this is the chart we had earlier. The gross profit basis would be sales less variable costs, or net profit plus fixed costs, 50. If you are doing standing charges only, it's just this medium bit that you insure. The dark blue bit is uninsured. What I'm going to do is go through the policy formula. Now, these slides look very similar to what we did earlier for gross profit. The differences are highlighted in green. Okay, so the process itself is very similar. Okay, so it would now be called item 1A is the loss of contribution to standing charges due to a reduction in turnover. We determine our reduction in turnover. We determine the rate of standing charges, not rate of gross profit, rate of standing charges, and then we apply that rate to the reduction in turnover. So the process is exactly the same. First job is to calculate the reduction in turnover. Now, as you see in here, this is exactly the same. So some clients think that if they switch to standing charges cover, it's a lot easier to calculate the claim. It actually makes no difference at all, because the fundamental part to any claim, whether it's gross profit or standing charges, is that you still have to calculate the reduction in turnover, and any claim drives off that all the time. So the process we'll follow for standing charges cover is exactly the same as what we would do for gross profit. No difference at all. So we'll look at the same examples that we had before. So don't know if I need to go through this in detail. We explained all of this before. There's no difference at all. Okay, so I'm not going to repeat all of that. Loss of contribution to standing charges. Well, what does that mean? This is the same as before. So we had our reduction in turnover of 100 for loss 2 and 40 for loss 1. But this is where it starts to change. Okay, so we have to determine our rate of standing charges. So that's the standing charges divided into sales rather than gross profit into sales. Okay, these are the costs we had before. Rate of gross profit was 50% before. But when we do standing charges, you can see they're only 30, fixed costs of $30. So therefore we pick up 30, it's only 30%. So what that means is that when we do then the claim, we have to apply that rate of standing charges to the turnover. Okay, this is loss number 1. Gross profit basis, 40 times 50% gives us $20. That's the same as what we discussed 10 minutes ago. Standing charges basis though, $40 times 30% gives us $12. So in this case, we've got an uninsured loss of $8. Now, essentially that $8 is the net profit that we've decided that we don't want to insure, which was 20%. 20% times our $40 gives us 8. That's the uninsured portion. Likewise, if we look at loss number 2, previously 100 times 50% gave us a loss of $50. Standing charges, it's only 30%, so it's $30. Uninsured loss of $20. So they're the principal differences between it. So any change to standing charges will always have an uninsured loss component. Now, for some clients, that might be fine. But for other clients, if they're going to lose what essentially is 40% of their gross profit, that could be disastrous for the business. I know you guys are a little bit bigger, so it's a little bit different, but still, it's a big loss to somebody. It just came to my door. I'm going to ignore them. I can't see who it is. Sorry about that. Okay, let's keep going. So the second thing that I want to discuss about standing charges is thinking about a net loss. Okay, so if you're making a net loss, as I mentioned earlier, it means your fixed costs exceeds your gross profit. Can you hold on 1 second? I've got someone at the door. Give me 1 second. I'm on a call. Got to go quick. Do I need to sign? You make it up. Just do it. Sorry about that, everyone. Okay. So assume a business with $100 of sales, variable costs of $90. Okay, so it's much higher. Fixed costs of 30. That means we've got a net loss of 20. That's depicted as we have over the side here. Okay. Now what you can see here is that the insured would only have $10 of gross profit to fund $30 of fixed costs. Okay, so gross profit would be 100 less 90, which is $10. But they've got fixed costs of 30. So they can only actually fund 33% of their fixed costs. The other 67% of their fixed costs, that represents a net loss. Now, importantly, in the event of a claim, you cannot be better off. So it's not possible to make a profit out of an insurance claim. So you will always be put back in the same financial position. So we've got to factor this in, the fact that you're actually making a loss here. So what does that mean here? So when we apply these rates over here, it starts to get a little bit complicated here. $40 times 30% gives us $12. We discussed that earlier, loss number 1. This is where we have to do an adjustment. Our net loss impact means that $8 is uninsured. You are unable to collect it because you were making a net loss before. You've got to make a net loss after. So you would only actually be paid $4. After loss number 2, same process. We calculated a loss of contribution of $30. Uninsured 20, they only get $10. So that's quite a big change. If we think back to the gross profit cover that we had before, remember it was $100 times 50%. So it's quite different, the numbers coming through here. So big uninsured losses. So overall, what do we need to think about? So using that previous example, the standing charges basis, the BI loss declared value would be $30. The loss number 2, which was the full loss, the claim amount after the adjustment is only $10. So what it means, you lose $20. So what essentially the client has done here is they've paid premium on a sum insured of 30, but they will never ever get paid more than $10 following a loss. So they've essentially wasted premium on $20. So 67% of their premium has been flushed away down the drain, and they will never ever get a claim paid for that. So in a net loss situation, there really is no point. As a comparison, if they did gross profit, it'll be an equilibrium. They pay premium on 10, which was the 100 less 90, and they'd be paid 10 after a loss event. So it's in equilibrium, it works. So regardless of whether we are making a gross profit, a net profit or a net loss, you should still insure on a gross profit basis because it puts you in an equilibrium position. Now, I know that was quite a complicated segment there. Before I go on to the next bit, does that make sense? Or has anyone got any questions? Or have I confused everyone so much?
Can you go back to 33%? Yes.
The 33% calculation, this one?
Yep, correct. How to calculate 33%?
How? Okay, so gross profit is $10. So it's 100 less 90, which is the variable costs. Sorry, I keep using my cursor on my screen, not yours. $100 less 90 gives you $10 gross profit. They've got fixed costs of 30. Okay, so 10 divided by the 30 is your 33%. They can only fund 33% of their fixed costs through gross profit. 67% is a loss that they're going to make anyway.
คือโดยปกติแล้วค่ะถ้าเราทำประกันภัยในแบบของตัว standing charge อย่างเดียวก็คือเหมือนกับเราทำเฉพาะตัว fixed cost ถูกไหมคะพอเราทำเฉพาะตัว fixed cost ด้วย definition ของมันนะคะมันบอกว่ามันจะต้องหักตัว net loss นะคือถ้าในกรณีนี้เราดำเนินธุรกิจแล้วเราดันขาดทุนตัว net loss ตัวนี้จะต้องถูกเอามาพิจารณาด้วยค่ะโอเคมีคำถามเพิ่มเติมอะไรไหมคะ โอเค
Okay, so that's the summary of net loss, why you would never use standing charges if you're in a net loss situation. I don't know if any of your subsidiaries are in a net loss situation, but if they are, this is what you need to think about. Okay, so moving on to the next one. Okay, so the next one can be a bit complicated to think about it as well, but this is where increased cost of working needs to be considered. So with gross profit, if you incur funds to mitigate your loss, to reduce your loss, then insurers will pay for that. Okay, so if you're going to lose $5 million a month because of a particular event, but if you go out and spend $2 million on a mitigation activity, then you save that $5 million loss. Okay, so the claim reduces from 5 to 2. Insurers will always pay that. It's worthwhile. It's economically justified. The insurers will love you for actually spending that money because it reduces their costs. However, if you insure on a standing charges basis, they're only going to pay you the portion that's helping them, i.e. the bit that you're insuring. The part that you are not insuring, i.e. taking on the risk yourself, as far as insurers are concerned, well, you need to contribute the increased cost of working yourself for that. Okay, it's quite a complicated clause down there, but that's essentially what it means. So I'll go through some numbers again to hopefully make it make sense. So it's this same numbers, but what I've done is I've broken down fixed costs into more detail. Okay, so it's still $100 of sales. It's still $50 of variable costs. Our $30 of fixed costs, though, is broken down into these 5 items. And then we still have $20 left over. So what we've decided here is the client only wants to insure payroll, interest, and rent. That's it. So $20. They don't want to insure admin and general. They don't want to insure repairs and maintenance, and they don't want to insure net profit. So what it means is that $20 is insured, $30 is uninsured. So therefore, of the $50 potential that they could have insured as gross profit, they're only insuring 20, which is 40%. Okay, running through it again, gross profit, 100 less 50 is $50. They're only insuring $20. 20 divided by the 50 is 40%. So they're only insuring 40% of their gross profit. So what does that mean? Okay, this is our scenario. So this client has an opportunity to mitigate their loss. They would have lost some gross profit through an event, but they've spent $20 to mitigate it. Okay, so they're back to normal. So the $100 of sales is still earned. $50 of variable costs is still incurred. Standing charges of 30 is still incurred. They've spent an extra $20 to mitigate that loss. So what does it mean? So what it means is that from a claim perspective, they will only get paid $8 from that 20, i.e. the 40% that we said that they were covered for. They decided not to insure net profit. They didn't want to insure admin. They didn't want to insure repairs and maintenance. That's 60% they decided not to insure is the uninsured loss that they're going to suffer, i.e. another $12. Now, again, this is something you just need to consider if going down the path of standing charges. For every dollar that you spend on mitigation, you need to split what's the benefit for insurers versus what's the benefit for me. And you only get paid the bit that insurers are benefiting from, which makes sense. Why would insurers pay it all if you're not actually insuring it all? So just a few recommendations for standing charges. I should highlight that this is a very, very useful methodology for some clients. The biggest claim I've ever dealt with was a huge semiconductor claim in China for $850 million. That particular client only insured interest, depreciation, and labor. They just couldn't be bothered to insure all of the other fixed costs and net profit. They had stacks of money being in the semiconductor industry, and they just decided to keep it simple and just insure 3 fixed costs. It works for some people. It just doesn't work for others. So it's important that you understand what doesn't work. Important that you will suffer uninsured losses if you go down this route. If you make a net loss, it will be even worse. You'll be wasting premium. And increased cost of working will only be partially reimbursed following a loss if you select standing charges. Any questions on standing charges?
So if our company have a loss-making profit and we have no uninsured loss, would we cover by the 100% fixed cost or standing charge? I mean, we have no gross profit. We have a loss of gross profit 100%. No, how to say? Our revenue.
A gross loss.
Less than gross loss. Yes.
Wow.
Correct. So in case
How can we set up the BI sum insurance?
Yeah, how can we prepare our sum insurance to?
Wow. Well, simply put, you can't. Okay, so if you think the declared value is your revenue less your variable costs, so if revenue less variable costs is a negative number, then the insurers need to pay you premium. It's not possible. Now, many of our clients have a gross loss situation if it's a new business. So, for example, you might start with low prices to get a foothold in the market, and then you will increase it later, and then you still incur you still have gross profit long term. But if this isn't a new business, if it's just the state of the market, then, well, I'd question why you would insure gross profit at all on that basis. If it will continue at that level, if you will continue to make a gross loss going forward, it's not possible to insure your gross profit. And there's no point insuring your fixed costs because you'd never get paid it. So it's possible that going down the route of buying increased cost cover would be a better way to handle it. So what you would do is you get paid compensation for those increased costs to try and continue the business. And I'm assuming that the reason for this is that this particular business is a part of a chain, and therefore the profit is made in other subsidiaries rather than this one. Otherwise, why would you continue in that business? That's just my thoughts. It's very rare that you come across a situation like this. Does that make sense, what I say?
เราอธิบายก่อนนะพี่ว่าเหตุผลที่เราต้องรัน
ภาษาไทยก็ได้ค่ะคุณเมย์
คือเมย์
ใช่ใช่
เมย์ช่วยเก่ง
เมย์ช่วยได้
มีอะไรเอ่ย
ไม่ใช่ cross launch ค่ะแต่ว่าพอดีถ้าเรามีหลาย entity อย่างเงี้ยค่ะแต่ว่าเรา have to run support ใช่ support ค่ะด้วย unit อย่างเงี้ยค่ะ
So we have a minimum demand, but sometimes some area need to be shut down to maintenance, and we have to turn the operation rate up to supply our ethylene to the polymer plants.
Is that you have a many plans, right? And yes, other can is support together, right?
อันนึงยอมให้มัน
ใช่ค่ะคือมีอันหนึงศูนย์อันห
เพื่
นึ
อง ให้ support
สามารถรันได้
supply chain
They have a many plan and each plan have the each P&L by themselves, but some plan had a cost loss, but some plan can get the revenue and can get the profit. So what should we recommend for the clients?
So, okay, so from a supply chain perspective, it thinking about the numbers and the way you've just described it, kind of suggests to me that the transfer pricing between the entities hasn't been set right. So that needs to be adjusted to make sure the profit actually is applied throughout all of the organizations. If you look at a standalone subsidiary, and that particular subsidiary is making a gross loss, it's not possible to insure it from a gross profit perspective. If you think about it, just in that one isolated business, in the examples we had earlier, if they had $100 of sales and they lose 40% of it, therefore you'd think, okay, well, they've lost $40 of sales. But the thing is, if the variable cost saving is bigger than that, they're better off because of the loss. So there is no loss to claim. So the insurance company will pay you nothing. So there's no point insuring it on a gross profit basis, just looking at that particular entity on its own. Now, if you had a policy that insured, let's say, 5 subsidiaries, and they were all vertically integrated, so one supplied another that supplied another, and all of those 5 combined did make gross profit and they were all on the same policy, well, then that's different, because that's a situation where, as a combined entity, you're still making money. But even to do that, you need them all to be in the same policy. You need to have interdependency cover to make sure that a loss at one of those flows through all of them and that the insurance company will pay. So it could get quite complex to work out a strategy. So if it's standalone, it's almost impossible to insure. But if it's in a combined group, then maybe there are ways around it.
เพราะเวลาเกิด KPI มันจะต้องดูทุก entity อะค่ะแล้วก็ลิงก์กันอีกทีนึง
ถ้าของกรมธรรม์แยกเนี่ย
กรมธรรม์แยกตัวที่มันไม่ถ้าเป็น gross loss ต้องเป็น0ค่ะแล้วควรทำเป็น additional increase cost of working แทนซื้อ AI account อย่างเดียวสำหรับตัวนั้นแต่ว่าถ้าด้วยลักษณะของ business เราก็มองว่ามันควรที่จะเป็นรวม
ต้องลง
ใช่ก็คือ
เป็นซีเนี่ยเขาแก้ปัญหาปิดคอร์สต้องมีอันอินชัวร์
ใช่
ถ้ามีทำเป็นปิดคอร์สตัวเบอร์มันก็เกี่ยวไม่ได้แต่
คือถ้าทำเป็น big cost อะมันจะถูกคำนวณเป็น portion ค่ะแล้วสมมุติเรามีค่าใช้จ่ายที่เพื่อทำบรรเทาความเสียหายถูกไหมคะ increase cost เกิดขึ้นมาไอตัว increase cost ตัวนี้ก็จะถูกเป็น portion อีกทีหนึ่งด้วยใช่มันจะไม่ใช่แค่ว่าประกันภัยจ่าย big cost ตัวนี้ให้เราเลยนะมันจะยังเป็นมีค่าใช้จ่ายตัวอื่นอีกที่มันจะถูก cross กลับมาอีกใช่ค่ะแล้วก็ apply เป็นเปอร์เซ็นต์
ตอนนี้เรามี interdependency แค่3บริษัทนะครับส่วนที่เหลือปัจจุบันเนี่ยถ้าสมมติว่าอย่างปัจจุบันเนี่ยเรามีบริษัทที่เป็น gross loss เราก็อาจควรจะต้องเซตสูตรแล้วกันเพราะว่าถ้าตอนนี้ทำ fixed cost อยู่อาจจะอย่างที่เมกาเนี่ยมันก็ได้เป็นแล้วอย่าง ICO แบบหุ้นอะไรเงี้ยหน้าที่ของเขาก็คือเหมือนกับเป็นการออกค่าใช้จ่ายเพื่อบรรเทา loss of gross profit แต่เราไม่มี gross profit ให้บรรเทาเนี่ยแหละครับพี่มันก็เลยจะแบบ
ไม่งั้นอาจจะต้องเป็นดีไซน์เป็น
AI ข่าวAI ข่าว
มันคือการเป็นอีกหนึ่งการคุ้มครองแบบหนึ่งค่ะที่เรียกว่า additional increase cost of working คือการคุ้มครองเฉพาะค่าใช้จ่ายเพิ่มเติมแต่อันนี้ก็ต้องเรียนตามตรงว่าเราจะต้องดู market อีกทีหนึ่งว่า market เขา respond ขนาดไหน
ซึ่งตรงนี้ถ้าสมมติ loss profit เป็น loss cost
มันไม่ต้องมี loss of profit ไม่ต้องมีอะไรเลยคือสามารถ
เซฟเป็นสับลิมิตก็ได้ถูก
ต้องแต่ว่าต้องเกิด BI ต้อง trigger ก่อนนะคะใช่ค่ะเขามันจะเป็นทุนมันจะไม่ใช่ทุนค่ะมันจะเป็นลิมิตที่ขึ้นมา
อย่างนั้นก็แปลว่าเราจะเซตอัพลิมิตยังไงให้มันแมทช์กับความเสี่ยงเนี่ยแหละครับนั่นคือประเด็นที่อาจจะต้อง
เราอาจจะต้องมาทำ loss scenario กันแล้วมาศึกษาร่วมกันนะคะว่าจริงๆแล้วเขาเท่าไหร่มันคือสิ่งที่มันเพียงพอหรือ enough กับ business ของเราอะค่ะ
ไม่ว่า AI ครับโอลี่อันนี้มันไม่ต้องเทสใช่ไหมครับว่าวิธีที่เราทำเนี่ยมันอีโคโนมิกหรือเปล่า
ถ้าเขาไม่ต้องเทสอีโคโนมิกค่ะโอเคคุณเกณฑ์ you can ไปต่อได้เลยไหม
Okay, so the next section, I'm just going to go through just a couple of clauses that I've noticed in the policy that I know you specifically asked to discuss the volatility clause, and there's a couple of others. So starting with the volatility clause, I mentioned earlier that you don't have average in your policy, certainly not the one I looked at. And therefore, there's no way that insurers can protect themselves against either a misdeclaration or a change in volumes or products and prices. So the way that they would do it, and this is quite common throughout the energy industry, is to use these volatility clauses. Now, my take on this is that what you've got here, so you've got two types of cap. So the first one is on a monthly basis. Okay, so put simply, if you have gross profit of $10 million per month, with the total for the year of 120 million, then if it's linked to 120% of your monthly declared values, then what it means is of that 10 million that you've declared, essentially you can claim anything up to 12 million, but then it's capped. And the reason why they would do that is because they recognize that prices could change. Sorry, I can hear chats. Is there a question? I didn't quite hear.
มีคำถามอะไรไหมคะ
อันนี้ไม่มีค่ะ
โอเคหรือก่อนหน้านี้ยังไม่เคลียร์โอเค you can continue คุณเกรซ
Okay, yeah, so on a monthly basis, it's capped at 120% of the monthly declared value. So it allows you a little bit of wiggle room. So rather than being exactly the same every month, it'll go up and down. You can go up to 20% over. Okay, but from an annual perspective, you can only go up to 15% over the total. No further than that. Okay, so month to month, 20% over the whole year, maximum of 15% over. If you go outside that, then it will be uninsured. Okay, now there's a few other complexities in here in the sense that the way that they actually apply it is down here if you've got an indemnity period greater than 12 months. So they use pro rata basis. But overall, this just allows insurers to limit how much you claim on a monthly basis. Now, if your overall production is fairly consistent, then it shouldn't matter. If the pricing is consistent, it shouldn't matter. It's only if something is out of equilibrium where there's a problem. I would recommend that if you have any kind of shutdown or turnaround situation where you know you are not going to be operating, make sure that you give the monthly totals to the insurers at the start. Because if you do an annual total, but that annual total includes, say, a couple of months when you're closed down, then if you've only got the total, they'll divide the total by 12 to get a monthly cap, and then you'll find that you can't fund the 10 months that you are operating for because you'll be capped at 120%. So give them the monthly declarations, which are full production, down to 0 during the turnaround, back to 100% again. That'll make sure that you can maximize your recovery in the event of a loss and still, hopefully, not fall foul to this volatility clause. Does that make sense? And this applies, in my view, this applies to both gross profit and standing charges cover. It would be the same regardless of which one you chose. Any questions?
What about the loan principal? Can we do the coverage for the loan principal?
Loan
I understand
principal.
Yes, I understand that it will not include in the P&L.
No.
But if we have the loan principal, can we insure it too?
No, you can't. You okay, so the way that it'll work from an insurance perspective, and this is the same for an operational BI policy as well as any construction policy, you cannot insure, or you should not insure, for principal repayment. Principal repayment is just purely a balance sheet transaction, as you pointed out. So the way to ensure that is to ensure gross profit. And the profit that you are making will be then used to fund that principal repayment. Okay, so you can't insure it as it's not a cost. It's a balance sheet transaction, so you can't insure it.
Thank you.
We move on to the next one.
Yeah.
So I just wanted to highlight here a clause you've got called alternative settlements clause, and it's a very useful clause for your industry. Essentially what this does is you replace turnover with output. So rather than we're not calculating a reduction in turnover, we're calculating a reduction in output. And then we convert that output to a monetary value based on the sales value of whatever you produce. Now, this is very useful in a situation where that can be actually very difficult to analyze sales, but production is much easier. You know how much a particular set of equipment will produce. And if you have a loss and you don't have that bit of equipment, you know how much you are unable to produce. So therefore, it's sometimes easier to calculate a loss through the output basis. But I do need to highlight that output basis really only works when you are operating at full capacity and that you can't catch up production and that you sell everything that you produce. Okay, so if you're in a situation where you are not operating at full capacity, then you can't really use the output clause effectively. But because what you'd have is a situation where you'll lose production, but then later on you can make it up because you've got spare capacity. So very useful clause, but only in certain circumstances will it actually be beneficial to you. Any questions about this one? Okay. So next one, I'm just highlighting this just because it's probably incredibly material for you. Now, I appreciate already that you used to have customers and suppliers cover, and it was taken out a little while ago just because it became too expensive and the market wasn't willing to provide it, was my understanding. So just to highlight what it is. So customers and suppliers cover enables you to make a claim where there's an insured peril that causes insured damage belonging to a third party that results in a business interruption loss. Okay, so it's the same three-step process we had earlier. The only difference is it's at somebody else's premises. So it may be your supplier. They've had a fire. You're insured for the fire. You're insured for the equipment that would have been damaged. That results in BI because they're unable to supply that material to you. So therefore you can't operate. And then customers and suppliers will pick up that. Interdependency is very similar, but the only difference is interdependency is within the same group in the same policy. Okay, so if you have one insurance policy that insures, say, 5 subsidiaries, those 5 subsidiaries are vertically integrated, where the product moves from one to the other, then in theory, it doesn't matter which of those 5 has the loss, you can claim a loss for all 5 businesses. Now, as you can tell from just thinking about that, that could be an enormous claim if 5 subsidiaries all have a loss, which is why it can be very difficult. But to highlight it, you've paid premium, full premium for the full BI risks for all 5 subsidiaries. So there shouldn't be a sublimit on it. It just means that the value at risk across the whole group is significantly higher. And therefore, I'm sure insurers will be pricing that into whatever they do. So very, very useful cover. But I do appreciate it can be difficult. Now, I haven't looked at all the policies. Martin helped me out by sending me a couple of policies for you. So I know that on one of them, that anything to do with the supply of gas on the offshore part of the program, there is customers suppliers cover for that part. And you have customers suppliers cover under the Thai oil policy. But it seems you don't have cover for all of the others. So it's potentially a very large risk that at the moment you are taking on yourself. And I appreciate you probably know this already. It just might be something that you want to look at just to understand what the risk exposure is for this particular type of cover. Any questions or comments on this one?
ได้ไหมคะน้อง
Okay. So there's only really one other thing that I wanted to highlight to you, which is just this process. Sorry, something there?
It's okay.
So just to highlight that we have many clients just like you who have these exact challenges that you're going through, where some subsidiaries may have a net loss. You know, you've got some that are linked, some that are not linked, and working out what kind of BI cover you need can be very challenging. It's a bit like a minefield. So we've prepared this structure to help our clients, to help them through that process, where we help them first of all working out what declared values they need. And as part of that, the type of cover that they need, whether it is gross profit or standing charges or increased cost of working only, looking at revenues, splitting the costs up into fixed or variable, looking at growth expectations, all of that information for whatever subsidiaries you have can be very useful to understand what kind of cover that you actually need to purchase for your business. We can look at policy wordings to make sure that it is actually covering what you need. I highlighted earlier claims preparation cost clause, which is obviously very dear to my heart. That could be better. So we could give you recommendations on maybe better wording that hopefully insurers will accept. We can give you more BI training. So we've talked a bit today about gross profit and standing charges. We sometimes give clients training for like 6 or 7 hours where we go through in detail all of the different types of insurance. We have assignments to do, we have a quiz, we have a whole load of things that they can really learn how BI works. And then we finish with loss scenarios where we can test maximum indemnity periods, some of the sublimits. I should highlight, with your kind of industry, we would have to partner with some kind of risk engineers that have to do the survey elements, because we're not engineers, we're the accountants. So we can calculate the impact of a loss scenario. We're not able to come up with a technical scenario itself, though, because that's too complex in the energy industry. So we just convert it to the financial implication of that. So this is just one way that we can help if what we've discussed today you think would be important and useful for you. We're obviously happy to help further. That's the end of the slides for today, but open to as many questions as you like. Or Martin and the team, if there's anything I've missed that you'd like to discuss.
So we understand that Mark should have his own claim team, right?
Yes.
Yeah. So for the claim preparation clause, we have to pay additional professional fee and claim under this clause. So I would like to understand why we have to purchase your additional service. Should it be the normal service from claim team?
Sure. Look, and that's a question that we're often asked. And look, as you would expect, we have a fantastic claims team, and that claims team will do everything in terms of the operations team, make sure that everything is received, notified to the insurers, pushed through the insurers towards settlement. We have advocates that push for getting what you need out of the process. But the part that is not included ever as a broking service is a forensic accountant to analyze your business, just because it can cost too much. I mean, I mentioned earlier that the largest claim that I ever did, 850 million. Our fee on that was $4 million US. So you wouldn't expect that a broker would be able to pay $4 million worth of costs to prepare the claim themselves. So the idea is that for all clients, if forensic accountants are required to make sure that insurers actually do the right thing and the claims prepared appropriately and you get what you need, that you have cover in the policy. And then you get recovery from that way. Okay, so I've had countless claims, even the energy industry, where our fees can be very, very large. You can imagine your business is very complex. If we have to rip it apart to understand exactly how your business operates, doing material balance analysis to the finest of details, that takes a long time and it costs a lot of money. That's why insurers offer claims preparation cost cover, so that you get that service that they'll pay for, but you have to engage us and then get the money back. That makes sense?
Okay, so if we engage much service and much cannot provide the settlement amount as agreed before, so do you have any like a service guarantee, or can we have any reduction, something like this?
You haven't even had a loss and we're already being negotiated. Look,
we need performance guarantee.
Yes.
In reality, look, the way that claims work is that we never know how big the claim will be. Okay, so I can't quite see how many of you in that room, but it looks like about 15 to 20 of you. I can guarantee if I gave you all a set of detailed financial information so that you could calculate an insurance claim, every single one of you would come up with a different number. So business interruption is incredibly subjective. So the skills required to actually pull that data together and get the best outcome for you is very challenging. But you can't just simply calculate the claim, submit it to the insurers and ask for payment, because everything will be analysed and debated. You know, how much would the price be that month? How much would production be this month? How long would that particular maintenance have taken if the damage hadn't happened? So many different factors come into calculating a BI claim that you never know what the number is until the very end. Now, we get as much as we can for you, and I can give you countless case studies where we've got significantly more than insurers want to pay. But we can never give you a guarantee of how much you'll end up with, because there's so many factors to think about.
Another question on your forensic service. Are you working on behalf of the insurer or reinsurer as a Marsh Forensic Service?
Marsh Forensic Service, we only work for you. That's
Okay.
100%. We never, ever work for an insurance company.
Okay, so mean that if we have a dispute with the reinsurer, so you will forensic team will be defend on our behalf.
Correct. Yes. Yep.
And how we pay, how you charge it is on percentage of the success or on a flat fee?
It's time and expense. So if you've got claims preparation cost cover, it has to be on an hourly basis.
How much
So
per hour?
Yeah.
How much per hour?
How much per hour? Well, it varies. So Kun Mei in the room there, she's $180 an hour. I've got a little bit more experience, so I'm 420.
And then
So it varies.
before negotiate.
That's
Before
already
negotiation,
discounted.
exactly.
Okay.
Yes. Well done, Martin.
Okay,
That's the right
everyone
answer. Already discounted.
So you have to analyze the workload first, and then you calculate how many hours. Just like a lawyer, is it?
It's like the we can estimate at the start how many hours we think we need, and therefore how much roughly it'll cost. But at the end of the day, we never know what will happen. We don't know. So if it's a big claim, the forensic accountants will be appointed by insurers as well to validate the claim. Now, some of those forensic accountants are very good, and they work with us to make sure the process is smooth, efficient, and you get what you need. There are others who are not, and therefore it is very, very challenging dealing with those particular people. And and they can blow out costs significantly just because they don't want to admit that they're wrong. And we keep arguing. I've got one of the worst cases I've had is actually one of your neighbors actually in Thailand, where there was a large claim a few years ago. And we kept making it clear to everybody that the loss was at a certain level. And the forensic accountants for insurers kept insisting that it was less than half what we're saying. The claim settled for exactly what we said it would be. But we spent about a year and a half constantly arguing with insurers, loss adjusters, forensic accountants. But when you're arguing over 10 to 20 million, it's worth keeping arguing for a year and a half because it's big money involved. And you never know what you're going to come up with. So if a particular forensic accountant is on the other side, we will always assume that our fee will be higher than normal, just because they're so difficult. But we represent you, and therefore we will keep fighting till the very end to get as much as possible for you.
How much you got paid for that case?
For that particular one, that particular claim, there was a $20 million claim, and our fee was about $160,000.
Oh,
Is it included dispute fighting with the reinsurers?
Yeah.
Okay.
Yeah.
It's worthwhile to pay.
Yeah, well worth it, right?
Yeah.
It's always worth it. We never have a fee in mind. I mean, the biggest claim that I told you about, where we earned $4 million of fees, the insurers wanted to settle that for $350 million. So we got the client an extra $500 million US. So they paid us $4, they got $500 back. It's a pretty good rate of return.
Yes.
Now we can't guarantee that rate of return on every claim,
okay,
but we can certainly add a huge amount of value.
Who is our neighbor? Initial word.
I'm not able to say that. I'm sorry.
Who is our noisy neighbor? Okay, we find out later.
I have a question. Besides the forensic accountant, do you have another professional to get involved in this in the BI claim to help the BI claim?
No, we will deal with all the BI claims. So we are the experts for the region, and we've got a team, and anything to do with business interruption comes to us to deal with. We have a team of advocates, and those advocates deal with more of the negotiations behind the scenes with insurers and the overall process. If there's a dispute over the policy wording, they will often take on those arguments. So we do some parts, they do some parts.
Forensic expert and forensic accountant expert.
ขออนุญาตอธิบายเพิ่มเติมอย่างนี้ค่ะใน March นะคะเราจะมีทาง Advocacy กับทาง Forensic นะคะซึ่งเราสามารถทำงานร่วมกันโดยส่วนมากของทาง Advocacy เนี่ยก็เรียนตามตรงว่าส่วนมากจะเป็น ex insurer ex loss adjuster นะคะซึ่งเราก็จะมี policy experts ในการที่จะให้ความเห็นในด้านของกรมธรรม์เรื่องของการ negotiation อะไรอย่างนี้ด้วยนะคะแล้วเราก็จะทำงานคู่กับทาง Forensic ก็คือทีมของทางคุณเกณฑ์นะคะก็คือทางเมย์เนี่ยก็จะ work คู่ขนานกันไปเราจะจับมือกันทำงานค่ะเพราะฉะนั้นเราให้ทั้งในเรื่องของความเห็นของกรมธรรม์นะคะแล้วก็คำนวณตัวเลข loss ให้แล้วก็ช่วย negotiate ด้วยค่ะเราจะทำจนกว่าลูกค้าจะได้เงินค่าสินไหม
แล้วในเรื่องของเทคนิคในการเข้าไป mitigate ว่ามันจะเคลมได้ภายใน
การ advice ถูกไหมคะเราก็จะเข้าไปช่วยด้วยค่ะเรามีฝั่งทาง advocacy แล้วก็ทาง forensic ก็จะช่วยด้วยอย่างเรียนตามตรงอย่างเมย์แบบbackgroundเป็น loss adjuster ถูกไหมคะก็จะสามารถที่จะ advice ได้ว่าอ๋อโอเคหากเกิด loss ต้องทำยังไงบ้าง1 2 3 4นะคะแต่เราไม่ได้มีทีมในการเข้าไปเหมือนแบบ recovery ให้เราอาจจะ suggest ได้ว่าโอเคมันมีบริษัท recovery 1 2 3 4นะหรือคุณควรทำยังไงแต่ไม่เชื่อว่าด้วยโปรโตคอลของทางปตท.เองอะค่ะเรามี supplier ของเราอยู่แล้วแหละแค่ต้องการคนในช่วยในเรื่องของการ advice มากกว่า
วิธีการ recovery ครับบางทีมันตีความได้หลากหลายรูปแบบว่ามันจะเข้า cross ไหนทีเนี้ยทีมไหนจะเป็นคนดูว่ามันจะเข้า cross ไหนมันจะเป็นประโยชน์กับผู้เอาประกันภัยมากที่สุดเนี่ย
เริ่มต้นจะเป็นทาง forensic ก่อนค่ะแล้วก็จะ consult คู่กับทาง advocacy แล้วจะทำงานร่วมกันไป คุณcan I just more explanation about advocacy and forensic work to the clients because that may be confused on our claim team.
Yeah, sure. It's a good.
I think it's worth also mentioning that the claims team can reach out to other specialists. So Glenn mentioned earlier engineering side of the company. And within our engineering group, we have some business interruption specialists. So they look at business interruption from an engineering perspective. And so they're people who've worked in the industry, worked in petrochemicals and so on as engineers, and then have transferred to insurance and have become BI specialists as well. So they, people like Glenn can reach out to that type of person to get a background to, the reasons why the loss happened and the engineering side of it. So there's a lot of expertise that we can bring to the table.
อีกคำถามนะเคลมvaluation fee นะครับที่จ่ายไปเนี่ยคืออันนี้มาสำหรับทีมที่เป็น forensic accountant only หรือว่าจะต้องไปจ่ายอีกครั้งหนึ่งให้กับทีมadvocacy ครับ
ไม่ค่ะ advocacy จริงๆก็สามารถชาร์จภายใต้ claim preparation cost ตัวนี้ได้ด้วยเช่นเดียวกันค่ะถ้า wording ที่มันดีไซน์มามัน reasonable พอ
คือปกติเขาจะจับมือมาด้วยกันเลยใช่ไหมฮะหรือว่าจะ
สำหรับของมาร์คเราจะจับมือมาด้วยกันค่ะ
คือเคลมแบ็กได้
อะไรนะคะเคลมแบ็กได้
ไปคืนได้
เป็นบิลลิ่งแค่ใบเดียวไม่ใช่เป็น2ใบ
เวลาเราโค้ดราคาเราโค้ด amount เดียว
โดยปกติเราจะชาร์จเป็นเอาค่ะเราสามใน internal เราสามารถเคลียร์กันได้ค่ะพี่
ใบเดียวค่ะ
ใบเดียวกัน
estimate มาให้ก่อนเป็นก้อน
สมมติว่าโบรกเกอร์หรือผู้รับประกันปัจจุบันเป็นเจ้าหนึ่งแล้วเราอยากใช้บริการของ Mass Forensic เนี่ยทำได้นะครับ
เรียนตามตรงทำได้ค่ะ
แล้วเราต้องมีทำสายเอกสารหรืออะไร
ทาง Mass สามารถที่จะนำเสนอเป็นproposal ให้ก่อนนะคะถ้าสนใจเราก็จะใส่ในเรื่องของตัว SOW หรือ Statement of Work แล้วก็ลงนามด้วยกันค่ะสามารถทำได้เพราะว่าเราก็มีลูกค้าหนึ่งที่ทางคุณเกณฑ์เขาทำงานให้นะคะเป็นของ another broker เป็นโบรกเกอร์เจ้าหนึ่งแล้วเราเข้าไปช่วยในเรื่องของการใช่
biggest claim in Asia เราไม่ได้เป็นโบรกเกอร์
we are discussing about your experience that you work for the client of non-client Mass in Thailand
Clients and non-clients, did you say?
Non-Mass client.
Non-Mass, yes. Actually, the biggest claim I've ever done in Thailand was for a non-Mass client. Actually,
more explanation.
I can give you some brief details of that one. So this was actually an energy client, another one of your neighbours, who had a loss a few years ago, and they specifically wanted us to help out to prepare a large claim following an explosion in a petrochemical plant. So we prepared that, what was it, 13 years ago, something like that. That's probably the largest claim that was a non-Marsh client.
Engaged to do the claim preparation cost for them.
Yes, correct.
Within 12 months.
Yeah.
250 million US.
Experience ที่ทีมเราของเรามีคือโดยปกติเราจะพยายามไม่ให้เคสมัน long term กว่า1 ปีอะค่ะเพราะว่าแบบเราเข้าใจว่าลูกค้าต้องการ settle claim ให้เร็วที่สุดเท่าที่จะทำได้
ครับอีกคำถามปกติเวลาเกิดเคลมเนี่ยเราก็จะเวิร์กกับregister แบบเรียกว่า closely อยู่แล้วครับไม่ว่าจะเป็นเรื่องของความคุ้มครองหรือว่าจะเป็นเรื่องของforensic accountant ตรงนี้แต่ตรงนี้ถ้าเกิดว่าของ Mass จะมี advocacy กับทาง forensic accountant ตรงนี้บทบาทมันก็ค่อนข้างจะเหมือนกับ register เลยครับ
ต้องเรียนอย่างนี้ adjuster อะค่ะก็คือทำงานในทาง on behalf ของทาง insurer ถูกไหมคะฝั่งเราเองก็ควรที่จะสิ่งที่เมย์ปกติจะบอกลูกค้าก็คือเราควรจะมีทีมของตัวเราเองในการช่วยฟิลช่วยกรองก่อนที่จะส่งออกไปหาทาง loss adjuster ก็ดีหรือทาง insurer ก็ดีอะค่ะใช่คือในเมื่อทางนู้นเขามีทีมของทางเขาถูกไหมคะทำไมทางเราถึงไม่จำเป็นที่จะต้องมีทีมของตัวเองในการที่จะช่วย support ข้อมูลของเราเองอะค่ะเพราะเราจะช่วยทำตั้งแต่สเต็ปในเรื่องของการหลังจากได้เอกสารมาเราทำเป็นเหมือน calculation ให้นะคะแล้วก็มาคุยกันก่อนว่าจริงๆแล้วตัวเลข estimate loss อะค่ะมันอยู่ที่ประมาณเท่าไหร่นะคะหลังจากที่เราได้ estimate loss แล้วเราค่อยส่งไปให้ทาง loss adjuster หรือทาง forensic ของทาง insurer แล้วเราก็จะเข้าไป take act ในแบบ on behalf ของทางปตท.เลยว่าเฮ้ยจริงๆอะมันเป็นอย่างนี้นะ1 2 3 4
ทีนี้การเปิดเคลมเนี่ยเราควรจะมีจ้างทีมของเราต่างหากทุกครั้งไหมหรือว่าจริงๆแล้วปกติถ้าเกิดเคลมมันสมูทปกติเนี่ย มันก็ไม่จำเป็นจะต้อง
คือส่วนมากอันนี้เรียนตามตรงว่าส่วนมากเคสที่เรา involve อะค่ะก็จะเป็นเคสที่ลอตค่อนข้างสูงนะคะถ้าเกิดลอตค่อนข้างสูงหรือลูกค้าไม่รู้เลยไม่มั่นใจว่าตัวเลขของตัว BI มันควรจะอยู่ที่ประมาณเท่าไหร่อยากให้ใครสักคนหนึ่งเข้ามาช่วยทำเคลมให้อะค่ะก็สามารถที่จะ engage ทางเราได้ เพราะว่าอย่างที่เรียนไปอะค่ะค่าใช้จ่ายเหล่านี้มันสามารถที่จะเคลมแบ็กกับทาง insurer ได้
ระหว่างเรา engage ก่อนกับเราไปเจอปัญหาแล้วค่อยมา engage เนี่ยอันไหนมันจะ
เรียนตามตรงจากประสบการณ์ค่ะ engage ก่อนเคลมจบได้เร็วกว่าไปเจอปัญหาแล้วค่อย engage เพราะว่าการที่ข้อมูลมันถูกส่งออกไปแล้วอะค่ะมันถูกรีพอร์ตออกไปแล้วมันถูกดีไซน์ออกไปแล้วว่ามันเป็นแบบนี้นะเราโอกาสที่เราจะสามารถที่จะกรองข้อมูลก่อนที่จะออกไปเนี่ยมันจะยากค่ะ
The next question. 1 million, is it enough to pay you? Preparation cost, just the BI loss, let's say 100 million US$. 1 million preparation cost, is it enough?
We normally rank on about 1%, so that's bang on about 100 million.
Okay.
As soon as the claim gets more than 100 million, then insurers start to question and validate everything.
Okay.
And therefore it becomes a lot more complex and more expensive. But look, $1 million of cover is probably sufficient.
Okay.
Because what you'll find is that if those very few occasions that you have a bigger claim than that, then even if you don't recover all of the money, you will see how much value is being added, and therefore you won't worry about spending 1.2 million and only recovering 100, because the amount of benefit you're getting from it, you will know, you'll see it, and you won't have a problem.
Okay, we just make sure that we have enough money to pay you. Otherwise, I may negotiate Martin to increase.
That's fine. That's fine.
Okay.
The bit you need to be more concerned about is the $100 million claim, making sure you get that paid.
Yeah, okay.
The little bit of fee for us is immaterial in the whole scheme of things.
Okay, so my next question. I have another question on, can you share with us your presentation? Because I have to
Sure.
go through all the figure. I still confusing, really mess up with the figure. So
Just give me 1 second to open it again.
Just say that later.
Okay.
You want to send it?
You need a presentation, right? Okay.
Say that later.
I sent it to you already. Yeah, I sent it this morning.
Okay.
Yeah, you've got it.
Okay.
It's okay, Kun Ken.
Okay.
Oh, you don't want it on the screen?
Right.
Okay.
Yep.
Yeah, no, we're
Yep.
fine. We're fine.
Okay, perfect.
Okay, from my listening for you almost 2 hours, if we have a gross loss, should we go for the ICW? Am I correct?
I didn't quite catch the question, sorry.
If we run the gross loss,
Yep.
should we insure on an ICW basis?
Yes, additional increased cost of working.
Yeah,
Okay,
W.
so there's two types of cost. In fact, I don't think you have additional increased cost of working cover in your policy, which is a gap in cover potentially. But if you have gross profit cover, then you automatically have what's called increased cost of working, and that has to be economically justified. So if you don't have gross profit cover, you can't have an increased cost of working claim. So there's extra cover called additional increased cost of working. So if you bought cover just for that, then that will pick up those costs that are necessary and reasonable to either mitigate a loss or to continue normal business operations. So that would be very useful if you're making a net loss or gross loss, sorry, a gross loss. But I'd like to spend a bit more time actually properly analyzing your business to make sure that that is the correct advice, okay? Because from what you've told me, that sounds like the right thing to do. But it's probably worthwhile analysing it properly to make sure that that is indeed the correct way to deal with it.
คุณเกรน I understand that if in case of the loss, right? If the fixed cost is higher than the loss, you still can insure, right?
You can still incur increased costs, yes, but you cannot insure gross profit. Sorry, hold on. Sorry, you were saying gross loss or net loss?
If you have in the net loss case, but you have the
net loss. Yeah. Sorry.
If the fixed cost is higher than the net loss, you still can insure, right?
ที่กำลังจะบอกว่าก็คือตัวฟิกคอร์ถ้าสูงกว่าแล้วลูกค้ายังเป็น net loss ใช่ไหมคะถ้าเป็น net loss เนี่ยจะต้องเป็นทำประกันแบบ additional increased cost of working
ว่าถ้าตัว fixed cost amount มันสูงกว่าตัว net loss ที่เกิดขึ้นมันก็ยัง insure ได้8เหรียญอย่างที่ใน
เขาก็เลยแนะนำให้ทำเป็น AI ค่ะเพราะว่ามี net loss
loss only อ่ะ
AI กล่าวมันไม่ใช่ loss ใช่ไหม
loss นะคะ
AI ข่าวมัน
loss
only
ที่กล้องแจ้งเมื่อกี้คือคุณกล้องจะเป็นเคสที่
net loss
ใช่แต่ว่ามันยังเป็น gross profit ได้
ก็คือ insure ได้4เหรียญ
ใช่ค่ะต้องทำเป็น gross profit ต้องทำเป็น gross profit แต่ว่าจะโดนตัวนี้นิดนึง
ใช่จะโดนทอนไปด้วยตัวนั้นออก net loss
โอเค gross profit แต่ net loss
ไม่ทำ gross profit แต่ว่าเวลาคำนวณนะคะจะถูกหักด้วย net loss
ไม่ใช่ก็คือเป็น gross profit แต่ net loss แหละพี่หนึ่ง
ไอ้ที่ลบ30
ใช่ค่ะ
Just to make sure everyone is in agreement. So if it's a gross loss, as in your variable costs exceeds your revenue, then generally increased cost is the way to go. If you're talking about a net loss, as in your fixed costs exceed your gross profit, then you should insure on a gross profit basis.
If we select the standing chart basis, in case of claim, do we have to calculate the rate of gross profit?
No, it's the rate of standing charges. It's the same methodology. It's just it's a lower rate of cover though.
Okay. Or do we have to compare the rate of standing charge with the rate of gross profit?
Yes, you would have to, because you will only, things like increased costs of working, you will only get paid a portion of those costs. So we need to know both.
Insurance cost, is it insurable?
Yes, it's a fixed cost. So yes, so your premium that you pay every year, that is an insured cost. It's part of gross profit. Any fixed costs that are paid out of gross profit, they're just inbuilt as part of gross profit cover.
Any question from online ไหมคะ
ผมขอถามคุณเมย์นิดนึงก็ได้ครับอย่างสมมติว่าเราทำเป็น gross profit basis นะครับแล้วอย่างไอ้พวก interest อย่างเงี้ยบางทีเวลาเราเกิดอุบัติเหตุเราสามารถที่จะคุยกับแบงก์เพื่อขอเลื่อนชำระได้ตามหลักการอย่างเงี้ยครับมันสามารถหักออกจาก gross profit อีกทีได้ไหม
เราจะมองเป็น fixed cost saving ค่ะเรียนตามตัว
ก็จะต้องถูกฟังก์ชันอีกเลย
ใช่
แม้ว่าเราจะแบบสมมติว่าเราเจรจา
ที่ end เราก็ยังต้องจ่ายหรือเปล่า
ก็ต้องจ่ายครับแต่ว่าแบบหมายถึงว่าเราอาจจะไม่ได้แบบมองว่าในช่วงที่เกิดเหตุอย่างเงี้ยครับเรายังสามารถผ่อนผันการชำระได้อะไรอย่างเงี้ยครับ
คือมันจะมองได้2แบบค่ะคือว่าถ้าเกิดสมมติมันถูก declare เป็น fixed cost ถูกไหมคะแล้วเราเอามาทำทุนประกันภัยไว้แต่ในช่วงเวลาที่มันเกิดเหตุแล้วเราบอกว่าเราสามารถที่จะ postpone มันได้นะโดยที่เราไม่จำเป็นต้องจ่ายตอนนั้นทาง loss adjuster เขาอาจจะมองเป็น fixed cost saving ก็คือตัว saving ที่มันจะถูกหักออกนะคะหรือถ้าเราบอกว่าเฮ้ยมันยังต้อง continue การจ่ายอยู่มันอยู่ที่ว่านะวันนั้นอะเราดีลไว้แบบไหนถ้ายังต้อง continue การจ่ายอยู่มันก็ยังต้องอยู่ภายใต้ fixed cost เราก็ยังต้องเราทำประกันภัยไว้ใช่แล้วก็
แต่ถ้าเราเจจะแบบ postpone ไม่ได้ก็คือสามารถตัด less ออกจาก sum insurance
แต่โดนพอชั่นอยู่
แต่หนูว่าโดยปกติมันควรที่จะเอามาเป็น fixed cost
ควรจะ
ควรทำประกัน
include
ภัย
ใน sum
ใช่
insurance
ถูกต้อง
แล้วถ้าสมมติเราทำเป็น sliding chart เนี้ยหมายความว่าพวก interest หรือว่าอะไรอย่างเงี้ยมาแก้ที่เกิดก็คือควรต้องมี
ถูกต้องค่ะใช่ค่ะคือปก
ก็
ติ
จะเป็น with cost บวก with service อะไรอย่างเงี้ย
ค่ะตัว
แต่อันนี้คือ
standing chart ถูกไหมคะ interest นะ
แต่ principal ไม่ได้
ชา principal ไม่ได้
ก็ต้องเป็น basis ก็คือต้องเป็น
principal คือแบบไม่สามารถทำได้เลย
ไม่ได้เลยค่ะเพราะว่าสุดท้ายมันไปอยู่ในเป็น
จบ
cost profit อยู่แล้ว
ก็จบเลยโอเคครับผมครับ
ค่ะ
ไม่มีใช่ครับจากบ้านไม่มีใช่ไหม
ทางบ้านไม่มี
ทำไมเนี่ย
ไม่แน่ใจว่า
ทางออนไลน์มีคำถามไหมคะ
ได้ทางบ้านพิมพ์แต่ไม่ได้มีพิมพ์มาค่ะ
ถึงบ้านนะ
No questions from online.
let me check
10 นาที
ไม่ได้ค่ะ
แล้วเราใส่ไปเลย
Okay. So today, on behalf of PV Group, would like to thank you, Kim and my team for support PV Group today, and also Ping and GPI team as well. And today, PV Group, I think this session very useful for us today. And when we have the time to learn more about your presentation slide, if you have any question, maybe we have to ask you again.
Yes, please.
Okay.
Yeah, thank you very much.
แป๊บนึงนะคะ
โอเค
โอเคค่ะ Thank you ค่ะ
ค่ะขอบคุณนะคะ thank you คุณเกณฑ์
Thanks, Glenn.
No problem.
That was very useful. Thank you.
That's good. Thank you. Bye bye all.
Bye.